S&P Global Ratings is out with its economic outlook for the first quarter of 2026 and is expecting AI tailwinds to boost otherwise weak growth. Joining me now, Paul Gruenwald, S&P Global Ratings Global Chief Economist. Great to see you.
Good to see you, Julie.
So let's zero in on the U.S. first, because your outlook there is for 2% growth.
Yeah.
But we've gradually seen over the past couple of years this trend of we expect one thing and it usually inches a little higher. So how should we be viewing 2026 through that prism?
That happened again this year, right? So after the tariffs, everyone was marking down growth. We didn't have a recession, but we had a borderline recession. But the tariffs were not as bad as we thought. So numerically, they're lower. There was very little retaliation to the U.S., and then it's taken time to pass through. So those effects were moderate, but now we've got these tailwinds. We've got AI in the data centers, we've got lower energy prices, and we've got pretty easy financial conditions. So now we're kind of back up to 2 at the end of the year, which is potential for the U.S., and we did the U again this year.
And how significant is AI as a percentage of that?
We don't have a direct measure, but we think it's at least half an extra percentage point of growth on an annual basis. And then the other way to look at it, something like 80% of domestic spending in the first part of the year was AI and data centers, which is huge, right? So if you scrape that out, you've got a labor market that's pretty weak, an expansion that's pretty narrow. So this is going to be a nice tailwind to growth for the U.S. for probably the next couple of years.
I mean, on the flip side, when we talk about tariffs, I just talked to someone from ISM, the Institute for Supply Management.
Yeah.
We got their manufacturing numbers today. What was it? 10th straight month of contraction in manufacturing. Now, I know manufacturing is not the largest part of the U.S. economy by far, but still, these tariffs are something that are designed, at least in theory, to help that sector, and it hasn't.
Yeah, we're not seeing the reshoring that was originally thought, but we're losing employment in manufacturing, we're losing employment in government, we're losing employment in tech. So aside from the data centers that we just talked about, there's really not much going on. But the manufacturing, we've basically taxed ourselves, right? We're taxing imports, either American firms or American consumers are paying that. We still have the policy unpredictability overhanging everything, and that's putting a damper on a lot of things, including manufacturing output.
And something that we've talked about in the past with this so-called K-shaped economy, or whatever you want to call it, the gap in spending, is that from an economics point of view, it's fine if the wealthiest Americans are spending enough to keep the economy afloat.
But we've been pointing out this narrowness argument for a couple of quarters. So the labor market strength is narrow, the demand story is narrow, the manufacturing story is narrow, and the consumer spending story is relatively narrow. So the top 10% are roughly sort of 40-50% of spending. So we're not getting the broad-based recovery, and that's probably not sustainable over the longer term. But short term, that kind of juices up the growth rate. So that's again masking some of this weakness.
Right. I mean, do we expect any broadening? And if so, what's going to be the catalyst for it? Is it going to be, for example, the tax bill and some changes?
The tax bill will help. Lower energy bills will help. But also the data centers are kind of spreading out across the country. They were originally concentrated right outside of D.C. and Loudoun County, Virginia. But now they're kind of everywhere. So we might get a multi-year boost for this smaller stuff. But, manufacturing coming back and building out the middle class, kind of 1950s style, that's definitely not something we see in the cards coming back.
You've mentioned a couple times energy costs being lower as being a tailwind. Energy costs, though, when you're talking about gasoline, are lower, but they're not lower when you're talking about energy, the power coming into your home. To be sure, electricity costs are not lower, and that's something that's really become this big talking point in the so-called affordability crisis. Is that cost of electricity?
Right.
How do you think about that?
Electricity demand has been flat for many, many years, and now it's starting to pick up again. We've talked about data centers several times already, but you've got examples of communities where some ginormous data centers being built, and those things need a lot of power, and we've got a big, sort of upward slope now for energy demand, electricity demand in the U.S., and that's pushing up utility prices. And some people are saying, hey, my bills are going up, and this data center down the road is pushing the costs higher. So we get back to these distributional issues we've been talking about for the last couple of decades, and this is just another example of that. These things are, going to generate some output and, generate AI, which is supposed to make our lives better eventually. But in the short term, they're pushing up electricity costs for these local communities.
So we've been talking all about the U.S. Globally, what do we need to pay attention to? Are we going to see sort of global growth, modest global growth?
Yeah, I mean, it looks okay. I mean, Europe and parts of Asia are actually benefiting from this digital infrastructure build out in the U.S. So you see it in Ireland. You also see it in Taiwan, in Malaysia, and in South Korea. So we're getting some exports of high-end sort of tech stuff from those guys into the U.S. Europe's got a little bit of a boost. This is Europe, so we have to scale our expectations appropriately. But with the German debt brake being released, we think growth could go kind of 1.25 to 1.5 on infrastructure and defense. China's a tricky story because we know they are world beaters in kind of clean tech, right? Solar, wind, electric vehicles, batteries, but they're still having a property overhang and kind of 4.5-ish growth. So we're going into a reasonably good year in 2026. It's not a great year, but we've got the US, kind of 2-ish, Europe 1.5, Asia 4. EMs are actually benefiting from those lower energy and gasoline prices. That's a huge part of their consumption basket. So that's a little tailwind for them as well.
And Paul, I'm curious, beyond next year, if you look into your crystal ball and how this AI story is going to play out from a labor force transformation aspect. I know it feels a little early to know, but what are you going to be watching and how are you thinking about that?
Well, I think on impact, the effect's going to be negative, right? We're already seeing some layoffs. The tech sector is not generating employment in the US. It is in Europe, by the way, which is kind of interesting. But the hope and the aspiration is we're going to get, new technologies and new ways of doing things. So on impact, we have negative impact on labor supply or labor demand, but then over time that kind of goes up and we get a sort of a labor renaissance and we get productivity and all that kind of stuff. That's baked into a lot of the pricing, so that's something to watch in the next couple of years. But that's the view now. It's still early days, but maybe next year we get a bit more clarity on both the macro payoff on the productivity and also the financial payoff on the earnings. Both of those have to come through.